Okay, let's get going. Yeah, I got 1 minute after 2 o'clock. Again, want to be respectful of everyone's time. I don't think this is going to take too long. So about 30, 40 minutes, depending upon questions. If you do have questions, I wouldn't say I'm an expert at this, but you throw it down in the chat or the Q&A. One of those will work. And I'll try to answer your question as we go along. If not, I'll get to it at the end. Okay, so what we're doing here today, we'll probably take about 30, 40 minutes, depending upon, like I said, questions. We're going to talk about the TIAA Traditional. Okay, and by the way, for those of you watching live or recording, you'll want to be in higher education. You wouldn't, maybe you would. You'd believe how many people jump on these webinars and listen to the recording that have nothing to do with higher education. So you want to be in higher education, and more specifically, you want to be in the TIAA Traditional. Okay, so let me introduce myself real quick and give you an idea of who I am and why you should care, okay? For those of you that don't know me out there, my name is Greg Shepard. I do have an investment advisory firm here in the Kansas City area. We're starting to pour down rain as I speak, but I work with folks just like yourself all over the country, just basically get the most out of your higher ed retirement plan. Been doing so for 20 years, over 20 years. So I've seen this TIAA Traditional more than I care, okay? So I know this thing just in and out, the ins and outs of it. And there's a lot. Here's how I'm going to tackle this webinar here. I've done a number of these webinars before. There's too much. I'll tell you this. There's too much information when it comes to this TIAA Traditional to go over everything. It is just an impossibility. So with that being said, I have a podcast. This is not, I'm not trying to toot my own horn, but there's a lot more information on this podcast that we can go through here, okay? My website, I don't even have it here, but it's safinancialservices.com. You can find the podcast there. I also have a YouTube. For whatever reason, these 5-minute YouTube clips, I'm shocked. I'm getting hundreds and hundreds of views. So the TIAA Traditional through YouTube is a great resource as well. So let's kick it off. I think that's good enough on the introduction. What we're going to do on this webinar, as stated in bullet point number 2, we got some people trickling in here. We're going to talk about the current rates. Okay, so if you're not aware, the current rates of the TIAA Traditional have gone up. With higher rates comes more questions, more interest, kind of the crux of this webinar. So I've had a lot of questions from folks I don't know all over the country, just like yourself, with this TIAA Traditional. So we're going to talk about the current rates. We're going to get into the liquidity issue right here. Folks, this is probably the most important slide that I have. This is the most unknown feature, misunderstood feature of TIAA Traditional. So we're going to get into that. Lifetime income annuity options. By the way, when we go through all these things, I'm going to hit the surface. Okay, I'm not going to dive into too many details. We'll be here all day. I encourage you. I can't encourage you enough. I emphasize. Make sure you get help when implementing any of these strategies that I talk about, or just doing it on your own, whether it's with an independent investment advisor. TIAA will help you. I'll dive into that a little bit later, but be careful about the advice you get from the company that owns the investment you're calling about. Okay, we can kind of put 2 and 2 together there. So we'll get into some lifetime income annuity options. One little known strategy, number 4, I think it's pretty cool. I did a little podcast and YouTube clip on it, garnered a lot of attention, and pros and cons and just my thoughts along the way. As we had a leaf blower outside right out my window in the rain, blowing leaves. You can't make this stuff up. Okay. So if you hear that loud noise, that's a leaf blower in the rain. Let's get going. Okay. So I know this is small. I literally just copied and pasted this. I can verbally tell you without you trying to, enlarge it on the recording. So what we've gone through recently, I say recently, the last, since by September, October of 2022, the Fed has raised rates. Okay, there is a correlation between that TIAA Traditional fixed interest on new credits going in and the Fed funds rate. By the way, if a lot of these things I talk about are foreign to you, that's fine. Make sure you reach out to me and I'll give you my contact information on anything that's just a little bit confusing, okay? Because a lot of this can be and will be confusing. But as it states right here, this is why I'm getting so much attention, or I guess TIAA Traditional is getting a lot of attention. I'm getting a lot of questions around it. Folks, new money is going in from November to now. You're getting 6.25%, 6.25% on the RA right here, the retirement annuity. A lot of you folks out there are going to have on the mandatory side, that's the 401A, where the employer is putting money in. Okay, that's an RA contract or an RC. And there's a difference, which I'll get into here in a bit. The RC contract is 6.5% on new monies going in. Why is there a difference? I'll explain that here in just a bit, but also keep in mind there's a floor. There's a minimum on what you can make on this. The RC, I believe, that's probably down here in the disclosures, maybe, but it's like 2.8%, something thereabouts. And the RA is at 3%, at least it was. Okay, it's not great, but it's not bad either. So take note of that. New money's going into these contracts, also supplemental. That's money where that's accounts where you're putting money in. 5.5 and 5.75. Are you kidding me? That's great. Okay. So I'm going to piggyback off that here in just a bit. That's obviously a pro of TIAA. Okay, folks, I'm going to drink some water here as we go along. I've been talking a lot already today. And this is probably right here, the most important slide that I have, arguably. Again, this is public information. I just copy and pasted this onto the slide here. So what you're looking at, I'll explain a couple of these. This column right here is delayed liquidity. I'll explain what that means here in just a bit. And this is full liquidity right here. So most of you out there, private institutions, you're mostly going to have, pensions are a thing of the past. I'll give you an example here. So most of you are going to have these RC contracts and the RA contracts. And actually, as of late, the last 12 months or shorter, we've seen the RA contracts convert to the RC contracts. Okay, it's not really any big deal other than the TIAA, and it probably mapped over your CREF, your equity investments, over to the new contract, and maybe change them up a little bit. Okay, there's reasons why they do this, but we don't have time or the desire to get into it. Okay, so delayed liquidity, what does that mean? Well, as it states here, we'll start with the RA. Right there. So think about this. You amassed hundreds of thousands of dollars in your TIAA CREF account over the number of years that you've been employed. You have X% in that TIAA Traditional. A lot of folks out there with not a lot of education or knowledge around the TIAA Traditional will have quite a bit in that particular fund, that investment. So you retire with 80% in TIAA Traditional. Well, guess what? Read that right there verbatim. The only way you get money out of that RA contract is by distributing it over, they call it a 10-year TPA, a 10-year transfer payout annuity, actually paid out over 9 years. Okay, make sure you heard that correctly. The only way you can get it out is over 10 years. Well, it's over 9 years, but it's called a 10-year TPA. Now, a lot of you have had these RAs convert to an RC. Remember, this is just a TIAA Traditional right here. The only way you can get it out, I'm going to give you a different strategy here in just a bit, but for most people, the only way you can get it out is withdraw that money. So you can do a one-time distribution like a rollover, but guess what? You got to do it within 120 days, and they're going to ding you 2.5%. So if you have $200,000 in the TIAA Traditional, that's $5,000. It's not the end of the world. I've done that for clients. For various reasons. Okay, I won't get into it here, but for various reasons, it can make sense. If you don't do that, right there, okay, you're subject to 7 years. You have to wait 7 years. You don't have to wait 7 years. We have to distribute it over 7 years. So RA is 10 years. The RC is 7. Now, a lot of you, less than a lot of you, will have these supplemental accounts. Okay. On the recording, when I send it to you, you can go ahead and read these on your own, but they're more liquid. Okay. This one is probably the most popular. lump sum withdrawals and transfers are available at any time with no surrender charges. So if we go back to this slide, and that's why the supplemental right here, it's less. See, the rates are less, okay, than the RA and the RC. You see that there because it's liquid. Okay, so not too many issues with the TIAA Traditional. On the supplemental side, that's where you're putting money in, the employer is not, other than the fact that you're getting less in interest. And just like I said at the beginning of this, just hit up the Q&A or chat if you have any questions going forward. I'll probably run back to some of these slides. Okay, here's some disclosures. When I send you the recording, oh, okay, so this reminds me. Where is it? Right here. Okay, so think about this. Let's go back to this slide. I had this question come up on a different webinar. It was a great question. So a lot of you folks out there, especially if you have monies at an ex-employer in the TIAA Traditional, what do you do with that money? Okay, there's various options, but we're sticking with the TIAA Traditional only here. So let's say prior to 06, you had all this, what the dollar amount doesn't matter. You have all this money in a TIAA Traditional or a current employer, but you're not contributing to that TIAA Traditional. The question here is, can you, the participant, take money out of that old contract, especially if it's a supplemental where it's liquid, okay, getting 3.6% and maybe less, take it out, put it in cash or whatever, stable value fund, which TIAA has, turn around and simultaneously, or I guess subsequently, put it back into the contract and get 6.25 or 5.5, whatever the case is, at the new rate. Okay. Brilliant. But I've told folks this. TIAA has been around a lot longer than you've been doing this. You ain't thinking about anything that they haven't thought of before. Okay. So the answer is yes. And by the way, Albert Einstein was actually one of the investors in TIAA. So that dates TIAA. They go back to the Great Depression in the 30s. So right here, you can do that, but I'll let you read that on your own. Basically what it states is that you can take the money out, but you have to basically wait 4 months until you put it back in. Now, one would say the Fed's going to raise that rate one more time in March, most likely. Okay, not guaranteed, but most likely. These contracts are sitting at 6+% on new money going in. If you did take those old monies out that were earning 34%, stick it in money market, whatever the case is, for 4 months, okay, next month, which is March, they're going to raise that rate. They're probably going to keep that Fed funds rate, I would guess, where it is going to be at 5% or higher, the Fed funds rate, so that the new credit going into that TIAA Traditional is probably going to be pretty good in 4 months. Not investment advice. Please consult somebody that knows what they're talking about prior to you implementing any of that I just spoke about, but that can be done. Okay. Hot topic here. Again, too much information to go over in a short period of time. I don't want to, dealing with TIAA Traditional, I tend to lose people pretty quick in terms of, holding on to their attention. This is one of those topics that, well, is quite frankly boring. Okay. So lifetime income annuity options. When you get the recording, I want you to go here to this link, chock full of videos that can do a lot better with the time given explaining. This is TIAA videos, okay, not mine, explaining the options with those annuity options. This one right here, this is a great link, income annuity estimator. And that's what I did right here. Very simple. It's take it with a grain of salt, though. There's a lot of variables that come into play that you can't really simulate with that estimator. So keep that in mind. Right here, what I did using that estimator, what I want to show you is a few things on this slide, and we'll skip over to the next slide. What I did in the estimator is said an individual that's retiring at 67 years old, spouse, so they're married, $200,000 in TIAA Traditional. What I wanted to do is see what kind of lifetime income annuity this person can get from that $200,000. Okay, pretty simple, very basic. Your situation might be a little more complex than that. So right here, it also makes sure if you do go in this alone or even talking to TIAA, make sure you understand all the annuity options. It can get confusing, okay? So the highest payment you're going to get is no beneficiary, okay? It's not necessarily a single life annuity option because you got right here, you have you and any partner. So in this case, a spouse would get $1,114 a month on the $200,000 basically deposit into the lifetime income annuity option. But check this out. Once you all pass, you and the spouse, children get nothing. Typically, there's children involved. Whomever you name as a beneficiary gets nothing. Now, look at the difference between the payments here and then down here, 20 years. So let me explain what this means. Let's just go to 10. Okay, so what this is saying is that beneficiary payments are guaranteed for 10 years if you and any partner on the annuity pass away. So typically there's children involved. Okay, by now, you're 67, in 10 years it'll be 77. So you're dealing with adult children here. Now, typically, hopefully, those children are making a living and doing fine on their own. But if you do want to provide for them, let's say you choose this option, you and your spouse, God forbid, pass away in 2 years. So that child or children are going to beneficiaries or they have 8 years left of $1,112 a month. Okay, but if you live to 90, guess what? Children get goose egg. They get nothing. Okay, from an estate planning purpose, probably not the best to go about these lifetime income annuity options. All right. Now, before I get to option number 2, think about this. Remember this slide? Right here, retirement annuity. So if you have a retirement annuity, transfers and withdrawals must be paid out in 10 increments, 10 annual increments, installments, okay? What if you were deciding between this, what's called a TPA, transfer payout annuity, between this is where it gets a little funky, and this, what's the difference? 10 years, right? So once you dump your money, let's say you have 200,000 in this TIAA Traditional, you dump your money into the lifetime income annuity option for a 10-year guarantee, that distribution is going to be about, you have to go and find out, but about 6-7%, okay, which is fantastic, right? If you chose to do this, okay, what happens is that this is where it gets funky. That RA contract gets dumped into what's called an IH contract. That IH contract is going to distribute you money basically in 10 equal payments, 9 equal payments actually. You're going to get less of a percent on that payout, but the money you get is liquid. Okay, and you can do whatever you want with it. You can invest it, you can do various things with it. It's not fixed and locked up. Hopefully that makes sense. Okay, oops. Where was I here? Give me a second. Going too quick. Okay. Very rarely do I see a lot of these options down here. There's scenarios where they could apply, but yeah, there are scenarios which I won't get into right now, but typically they're not good options. There's not a reason for them. Now, let's think about this. We've got $200,000. You're 67 years old. You're looking to retire. You got this money. It doesn't matter. Probably in the supplemental. Okay. I get this question all the time. This is very simple for you to Google this information. That same 200,000. Now, this is why. Let's go back to here. Remember I said this right here? If you have an RC, within 120 days of separation of service, you can take that money out. If you have $200,000, that's $5,000 less. That's $195,000 you can do as a lump sum to a rollover IRA. So you've taken advantage of the accumulation credits for the last 20, 30 years, whatever the case is. You take a haircut, is what they call it, 2.5%, 5,000, you have 195 to work with. Now I put 200 here, but in theory, it still applies. That same $200,000 that you could have annuitized if you invested in a certain bond fund, getting 5%, which is fairly, I'm not going to say easily done because, this is an investment advice or anything like that. But that's pretty common. NAV plus interest. In 20 years, you'll have about $85,500. Okay. So this is all liquid. This is liquid. So what I'm getting, and also from an estate planning purpose, your kids get that upon you and if you're married here, you and your spouse's death. Okay. So from an estate planning purpose, this is so much more advantageous. All right. Now, I'll tell you this. I always, not always, but I do tell this example. I don't see any questions yet. I know some of this can be confusing. And I guarantee any question you have, others have the same question. So I had this client, let me give you an example here. Well, she wasn't a client at the time. This has been not that long ago, probably about 5 years, she became a client. So she wasn't a client at the time. Of course, she was referred to me by a colleague. This is a university here around town. Okay, we have actually several universities around the Kansas City area. But she came to me. I met her at her office, actually. And, I asked her situation. She'd been there for like 30 plus years. So she'd been there a long time. She's widowed. Okay, that's important for this story because she had nobody to bounce ideas off of. She had nobody to talk to in regards to this other than TIAA. All right. So she had amassed over the course of time, 800,000 roughly-ish dollars in TIAA Traditional. 100% of her account was in TIAA Traditional. All she's done is she has nobody to talk to in this regard, right? And she looks at the investment choices. Somewhere along the line, maybe when she started, someone said, hey, that TIAA Traditional is guaranteed. That's the key word, guaranteed. Folks like that word, guaranteed. So she said, yes, I'm a conservative investor. I want that 4+%. So she's set it and forget it. And then 30 years down the road, I run into her and I knew it was going to happen. So I was the bearer of bad news. I had to drop the bomb on her because this lady, she was prior to 70, she started having health problems and she wanted to use that money. By the way, her university, it was archaic in the sense that they still had a pension. So what I'm getting at is she had a pension, fixed income, right? Pension. And then she has TIAA Traditional, which is what she didn't know at the time. I told her is fixed income. Okay. She can only get it out over 10 years if she chose to do that, or a lifetime income annuity option. But my point here is her health was failing. And her goal with that money was to go on these lavish vacations, to use that money more than what could pay her on a monthly basis, either through a lifetime income annuity option or from a 10-year TPA. And she was devastated because she couldn't do what she wanted to do. Now, I told her, you could put it on credit, of course, and then pay it back. She had plenty of money coming in, but she felt it was a very emotional time period for her. And she was angry. She had talked to TIAA reps for years. Now, she says they never mentioned it to her. I don't know that to be true, but there was bad communication because here we go. We got a client, or I guess a participant of TIAA that didn't know the extraction, the exit strategy. Okay, I can't emphasize this enough. If you have TIAA Traditional, you need to have some sort of exit strategy. Speaking of, check this out. This is pretty cool. This is a little known strategy. I've done this many, many times with clients. It doesn't fit for everybody. But let me just explain what this is. So what you can do, I've never seen it where you can't do this. So, make sure you contact someone prior to doing this, or you might, be disappointed. You can actually initiate these TPAs while still in service. And I'll tell you why it's important here in just a bit. So the logistics is, let's go back to this page. Right here. Doesn't matter. Let's say you have an RC or an RA. So this is a mandatory. The supplemental is a lot easier because it's liquid. So you have an RC or an RA contract. I don't see too many of these, but this is the same thing basically as an RC. Okay, you can see a few differences, but there's not too many differences. So the more popular contracts is the RC and the RA. So if you have an RC or an RA or any contract thereabouts that's not liquid, you can call TIAA and say, hey, I want to initiate the TPA within my contract. I'm still in service, and take those distributions, keep it in my contract, and divvy it up amongst the investments that are still in the contract. Okay, hopefully you followed that. Why is that important? Okay, for a number of things. I guess the strategy I'll get into here. Let's see if I have it. I'll take, okay. Is that, well, one, if you're just learning about it, let's say you're 60 years old and you're going to retire at 67, and you have no interest in any of these annuities. You don't want to do a lifetime income annuity option, but you didn't know about what I'm talking about here, that the only way you can extract it is over 10 years, and you have an RA contract. Well, you can go ahead and start that TPA. You can turn on the spigot, as I call it, and take those extractions, those distributions, just once a year. And then when you retire at 67, you only have 3 more years, actually 2 more years, because it's paid on over 9 years to go, rather than waiting until you're 67 and then finding out that you have 9 years to take that money out. Okay. And maybe you just don't want, now, right now, the credits are good. Those interest rates are good, but at some point in time, the Fed funds rate is going to go down, and those new credits going in aren't going to be as attractive. So at some point in the future, you just don't like, or the old money, you don't like the interest that's being generated. Kick on that IH contract, which is the TPA, and then divvy those distributions up amongst the investments that you currently have within that same contract. Okay, makes sense? Okay, we're about 30 minutes into this. I don't see any questions. So that is why folks do that. Okay. My take on it, I told you a lot of information here. You can probably maybe sense of where I lean when it comes to TIAA Traditional. I've been dealing with it over 20 years. This is the most attractive rate I can remember. I've been doing this since 2001, 2000. There may have been a time where there was a more attractive rate. It'd be hard pressed. So for that reason, it's a pro. Okay, I got pros and cons. Good rates currently. Guaranteed income. I got plenty of clients out there. This is where it can make sense. If you're of the ilk of the mantra that you want that predictable income, you got it with TIAA Traditional. Okay. Okay, so here's another strategy. Could be a good number 3. Could be a good alternative to your bonds and cash options. Cash options. I just spoke to an employee. What is today? Wednesday? Geez, it was last week actually. He was rattling off the bond options within his contract, which I told him to contact the employer because it was ridiculous. He had 3 bond options, of which none of them were worth his pen. They were terrible, but that TIAA Traditional was paying 6+%. So I said, and he was young. So I said, think about this. Instead of the bond and cash options, if you want that sleeve of your portfolio conservative, let's dump money into the TIAA Traditional. It's restrictive. He had, I think it was an RC contract. So we knew this going in, but his idea was once those rates start going down and the new credits going in aren't as attractive, or if they're still attractive and he's 55 years old or 60 years old, he'll kick on that IH contract, that TPA, and kick it out of the TIAA Traditional into the investments that he has in that contract. Okay, so he has a strategy. So it can be a good alternative to bonds in cash. Cons. I pretty much went over all the cons. Liquidity is number 1. Folks, you know the old saying, you don't know what you don't know. I can't tell you how many folks out there don't know about the liquidity issue or lack thereof. Because 10 times out of 10, your 401as, depending upon where you are at the institution, your accounts where the employers putting money in, and then there's some kind of match or something like that, those accounts are going to be a lot larger than your supplemental accounts. That just goes without saying, okay? So you don't know what you don't know, and a lot of folks don't know about the liquidity issues on that mandatory account, and there's a lot more restrictions than that supplemental account where you're putting money in and the employer's not, okay? So I put it right here, it can be good for those that know how to use it and that have a game plan around it. However, as I write here, most of the time, I don't know if it's most of the time, I'd say most of the time, I was gonna say it's more than that. Folks get into the TIAA Traditional because they're attracted to that guaranteed rate and have absolutely no exit strategy. And again, you don't know what you don't know, so you can't have an exit strategy if you didn't know the restrictions around that TIAA Traditional. In this case, if someone that doesn't have an exit strategy, don't like it at all. And that's for most cases. That's for most folks out there. They have no exit strategy on that TIAA Traditional. I think personally, I think you can accomplish, I know you can accomplish the same things you're trying to accomplish with TIAA Traditional without TIAA Traditional. Does that make sense? What you're looking for is a guaranteed, now you can't get guaranteed elsewhere, okay, but you're looking for that guaranteed, you're looking for a good solid rate of return like 2022 when everything's down. You have that solid 5%, 5 or whatever it was in 2022. I get it. And at the end, maybe you already know that you want an income stream. That's a definition of an annuity, is an income stream, predictable income stream. Folks, you can accomplish that other ways without getting into the complexities and the nuances of the TIAA Traditional investment itself. Okay, so what do you do from here? I get this question a lot. DIY, do it yourself. Perfectly fine, right? You've been doing it probably by yourself up until now, because TIAA-CREF, they have folks you can call, but they're not supposed to give you investment advice. So you're doing it yourself now, right? And as I say, number 2, okay, so you can call TIAA, right? Of course. I always ask folks, well, who pays their light bill? Tongue in cheek. So they're going to tell you things that are advantageous to their company. I mean, that's what all employees would do. So they're going to try to keep you with TIAA Traditional, okay, or just with TIAA in general, okay. And by the way, I don't think I mentioned this up front. Some people get confused. I don't work for your university, okay. Never have, never will. I don't work for TIAA. I don't work for Fidelity, okay. I don't work for any competing company. I have my own independent investment advisory firm. So I'm unbiased in this advice, if you want to take it as such. I don't have a dog in the fight. This is just education, okay? So, but TIAA folks work for TIAA. So they're going to try to keep you with TIAA in that regard. I think the best thing to do is contact an independent financial advisor, someone like myself, of course, but you got to be careful. I've taken clients on from other advisors that don't have a clue about this stuff. Rightfully so, they don't dabble in the higher ed world. So if you do hire a financial advisor to help you out, most people this is foreign to, because you've done, number 1, your entire career with the help of TIAA along the way. So make sure that that person, he or she, the advisor, knows what they're talking about, okay? And I emphasize right here, here's my contact information. I give you my phone number. I've been doing these webinars, podcasts, YouTube things for quite some time. I don't think anyone's ever called me. They've always emailed me, okay? So, but that's my phone number if you want to give me a call. Email me, call me with anything. I answer questions all the time. I do it all the time. So don't feel like you're I don't know, I'm going out of the way, okay? I'm here to help you. Make sure to have a game plan. And I do have clients. So ask me about that if you're interested in me helping you out. Of course, I do that for a service. So that's it, folks. About 35 minutes, actually a little quicker than I expected. I don't see any questions here. And I can't think of anything. There's a ton of stuff I didn't mention. There actually is. But this is very surface, okay? Check out that podcast. and YouTube to dive into more information, and email me anything that's on your mind or you think I didn't cover or something I flubbed up here, and I'd be more than happy to respond. All right, folks. I don't see any questions. I'll leave it open here for any questions, but I'm pretty much finished. Okay, any questions you can think of? Okay, a few more seconds. I think this is the first webinar I've done where there are 0 questions. Either I was talking too quickly or something of that nature. I got nothing, or I guess you all have nothing. All right, folks, that's it. Greg Shepard, SNA Financial Services. Hey, you all take care. All right, thanks for tuning in. Bye-bye.